All right, welcome everyone to the May market update for ClearVista Financial and ClearVista Financial Perspectives. I am Mark Trice, financial advisor, joined in here in the studio today by Jesse Hamilton.
Hey, everybody.
Happy May Day, Jesse.
Happy May Day. It
Do
is
you,
May
need-
1.
do you even know what May Day is?
It's the first day of May.
It is the first day of May, but it also signifies a huge Communist Party celebration, which started as a labor movement in Chicago in the late 1800s.
I did not know that factoid.
Yes, and you should see this week sometime, you'll also see the Soviet parade celebrating supposedly the victory in World War II over Hitler. And so lots of May celebrations going on. It's interesting to look at ChatGPT and ask them about May Day, and they refer to the Haymarket Affair, which was actually riots in Chicago. You know, Chicago used to be a really peaceful city, or maybe as dangerous city back in the 1800s.
Well, we've had some of the most hyper volatile swings in history.
Yeah, I'm still talking about May though. So, you know, we got May the 4th coming up. May the 4th will be
Big
a Star Wars
Day.
marathon. May the 5th, Cinco de Mayo. So May's a great month.
May is also my birthday month.
That's right. Jesse turns a year older this May. So let's jump into our thing. A lot of stuff going on this last month. Many of you may have thought that it was the end of the world, but it is
Mark
not.
was playing various renditions of the end of the world
Yeah,
songs.
it was surprising how many songs we found that talked about the end of the world.
It is not the end of the world.
It is not.
As far as we know today.
So Jesse, let's go kick it off. Let's talk about our agenda real quick and we'll jump into the program. Sorry for my distraction.
That's all right.
Day.
That's all right. So today, of course, we'll focus on the index performance. I think that we're going to be pleasantly surprised with how they closed, despite the just hyper volatility that we saw in the month of April. And we'll go into a macroeconomic update, kind of talk about the state of the tariff situation, what we're looking for in the coming months, and the Federal Reserve. And we might even talk about how President Trump and Jerome Powell are calling each other names like little school children, but there's a lot going on right now. If you ever want to interact with us now or watching the recording later, 254-282-0495 is our text line, or an email to info@clearvistafinancial.com.
All right, let's go ahead and turn the camera off so we can share more real estate with the audience.
All right, so
give us an update.
Started. First up here is just kind of an overview. Doesn't look so extreme, does it? Despite the volatility of the month of April, the performance numbers at the close of the month actually look quite tame. And the S&P 500 closed minus 0.76%, the NASDAQ plus 0.85%, the Russell 2000 minus 2.32%, and the long-term Treasury index minus 1.71. Very interesting here. Our moderate index that we follow closed at the exact same price to the penny that it closed.
To the penny, really?
In March, yeah.
So really, April was just kind of a waste.
April didn't exist. Yeah.
April didn't exist in the markets except when it comes to the moderate index.
Right. So let's go in a little bit more detail here and see what happened. Here is the S&P 500, and yes, we changed things up a little bit and made it a line instead of a candle, a little bit easier on the eyes. But this blue line here is the performance of the S&P 500. And once again, this is our large cap US index. And we all know what happened in the first 5 days of trading this month of April.
It always happens when I go out of town.
Yeah, the index fell 13.85% in 5 days.
5 days. That was pretty scary during that time.
Yes, it was.
You know, we sent out an update, a video update to our clients around that time, but it kind of felt like it was a little bit of a scene from Animal House where Kevin Bacon's trying to get the riding crowd to remain calm.
Remain calm. But after that extreme downswing, in the next 3 trading days after that, this is the first and second week of April, we had the third single biggest day in the S&P 500 since World War II. That was in
Wow.
on April 9th. It swung positive 13.37% in 3 days. So almost everything that it had lost in the previous 5 days, it made back up in 3 days. And then, of course, we can see that throughout the rest of the month, the policies that people were scared of and freaking out about seemed to ease, even though we still have great uncertainty.
It was very much headline driven.
Very headline driven.
Very much headline driven, the reaction to those things. And we still have vulnerabilities to that because that there can be a headline driven reaction to almost anything.
Mm-hmm.
I know during the first Trump term, we were watching at the time it was called Twitter. Now it's called X because President Trump might tweet something that could cause the markets to move.
I think he technically did release his 90-day pause notice on Truth Social, so that one little post on social media created what, about $5 trillion of value just because of one guy posting a tweet. So it's a lot of power.
Yeah, so try not to read the headlines. Certainly don't pay attention to the news media about what's happening in a particular day. Remember the old adage, I think it was the editor and owner of the Chicago Tribune that always said, if it bleeds, it leads.
That's right.
And that's what sells news and eyeballs to glue to the TV or your computer is if it's bad news.
So as you can see from the low there on April 7th to the close of the month, we were up 15.9% and essentially closed around the same place that we opened the month at.
Okay.
So here's the NASDAQ 100, our tech-heavy US index. As expected, it behaves just like the S&P, but with more volatility, usually. It was minus 14.54 on those first 5 trading days. And then it rose 18.01% through the end of the month. Once again, historical levels of volatility in this index.
And we're still below the highs that we saw in March or pretty close to them?
Yes.
Okay. All right. So once again, a lot of volatility.
Here's the small caps, the Russell 2000, didn't quite recover as nicely as the large caps. Minus 13.91 for those first, actually it was more like a week for this index. And then it ended up closing minus 2.32.
And the small caps are more susceptible to interest rate environments as well. And we saw yields going up in the month of April, and that had it continued to have a little bit of drag on small cap companies.
We'll take a peek at the long-term Treasury index here. It peaked there on April 4th and decided to then decline all the way minus 9.66, about 10% to the low on April 11th there. And yeah, that's extremely volatile for what a lot of people consider to be a safe asset class.
Right. So bonds are still not out of the woods yet and have not recovered from their all-time highs in 2020.
And then here's our moderate index. As I mentioned, it closed to the penny at the same price month over month. That's a 0% movement. That doesn't mean that your portfolio did not behave the exact same way, but that's an index that we consider to be one of our many benchmarks.
Okay. And let's just give our disclosures. Benchmarks are benchmarks and indexes are indexes. They're things that cannot be bought and traded.
That is right.
Please read carefully. So let's put this all in perspective, Jesse. You had drawn this particular chart to kind of illustrate a point.
Yeah, so here's yes, we did see historical levels of volatility in April. The headlines made that seem even more extreme than it was. It was a big month. It was a very historical and important month for the amount of movement in the price. But
I think the VIX was over 50
yes,
at some point, and we normally don't. We prefer it when it's in the low teens.
right. But people are considering, or if you just pull up Fox Business or Bloomberg, any of these business outlets, you're going to see them comparing the month of April to COVID and 2008 and 2000, and a lot of them blaming this tailspin on Trump and other policies and things. But this chart here goes back just 15 months in the S&P 500. I've drawn a pink line at 5,614. That's where we closed the month. But notice what happened at that price level last year.
Yeah, we had a little bit of a pullback at that point as well. But we kind of retraced, if you will, back to really June, May or June, July levels of last year. Okay, that's a lot. But it doesn't mean that the bottom has fallen out. And I think a lot of people were basically calling us a little concerned that the end of the world is near. And a lot of those people are just listening to the headlines and they're not looking at this from a larger perspective, a longer term perspective. You know, we always talk about it's not about, you can't time the markets.
Right.
And so no one knows where the high is and no one knows where a low is. It's, you know, if you're trying to get out of the market and hope that it doesn't fall any further, it's kind of like trying to catch a falling knife, right? You know, you're more than likely you're going to get cut.
Yeah,
And we believe that the time in the market always beats timing the market.
exactly. And we've gotten dozens of calls from clients in this month asking, should I hold off and not put my money in till later, or should I pull all my money out of the market? And those kinds of questions, surprisingly, have nothing to do with the performance of the index. That has all to do with your financial plan and how that is going to impact your long-term goals. So we are not suggesting that you time the market, decide to put money in or take money out based on the price movement in April. That's all I'm
And,
saying.
and it's interesting because, you know, people will call in when it's at the bottom and they decide that they're going to get out.
Mhm.
And that's the
That's the
worst time.
worst time you could
That's
possibly
the
do it.
worst time to get out. If there's something that you can see that we can't see, let us know. But we're investing for the long haul, and we want to make sure that our clients are not overreacting to different things, but looking at the long-term picture and focus on your financial plan.
Right. So this is data from many decades of volatility. This year most likely will be different, but we are heading into a season of reduced volatility. We're heading into May, which is where the summertime usually calms down a little bit, and the blue line there is the volatility index. Does
And
that mean we're gonna
that didn't follow the same pattern as we see on the screen here
no,
this month. So doesn't mean that's a predictor of the future. It just means on a seasonal basis, we typically might see um, volatility drop in May.
right? I had this slide last month and I just really liked it because it goes back to 1990 and shows the performance of stocks using the S&P 500 and bonds using the Bloomberg US aggregate. Stocks are in the dark blue color and bonds are in orange. And I just thought it was very insightful to kind of look back at some of these historical events, these bear market situations, and also the historical rebounds that happen after market downturns.
I wish we could look, and I know you don't have your arrow to point on this, but
I can
looking
try.
at 2018, it's right over here, Jesse. 2018 is when um, Trump last put in tariffs. That's when we began to see the impact of that. And we ended the year, so you can do 13, 14, 15, 16, 17,
Hmm.
17 and 18 is when he put those in. Those are positive years that the S&P was positive.
Right.
So we've seen this before. We know what could happen, and we're simply just saying, let this ride itself out.
Yes. And once again, success isn't about picking the winners or timing the market, but instead building a portfolio that weathers these changes over what we've seen in history.
So remember, folks, you can send us a question at 254-282-0495 or email us at info@clearvistafinancial.com. That's not just during the market update. You can send that to us anytime. We will try to get back with you within 24 hours. If it happens to be on the weekend, it'll be Monday. But happy to visit with you about any questions or concerns that you have.
So the Fed did not meet in April, they are meeting in May. I've been reading several commentaries this month that experts are pricing in 4 quarter point cuts by the end of the year. I think that's extremely optimistic. We have no idea how this tariff situation is going to impact the Federal Reserve's data and their dual mandate to be looking out for the American people, and of course being completely unbiased from politics, as I jokingly say, because the tension between Trump and Powell rose this month. They were kind of jabbing at each other, Trump wanting Powell to cut rates and threatening to fire him, even though Powell on his own authority cannot cut rates and Trump on his own authority cannot fire Powell. That's just how they were bantering back
It
and
makes
forth.
a good headline.
Exactly.
Trump and it's really, I mean, I'm sure with in Powell situations, like, go ahead, man, I don't want this job anyway. But yeah, neither one of them can influence policy like that. They just are kind of bullying each other, and kind of reminds me of, here I'm dating myself, the original Pee Wee Herman movies, where
Uh-huh.
he would constantly say, "Yeah, I know you are, but what am I?" And it's like that childish dialogue that these two are having with each other. And the honest opinion is that the Fed's not going to be influenced as heavily as by politicians as the public thinks they can be.
hmm So if the Fed funds target right now is 4.25 to 4.5, the leading economists are predicting that that would be 3.25 to 3.5 by the end of the year. And I mean, that would be fantastic for lots of different reasons. People trying to borrow, things like that. It'd also free up cash in the flow of the economy and everything. But that does seem optimistic to
Yeah.
me.
And we're just kind of what some of the forecasts have been. If there are four cuts by the end of 2025, that will only bring down the overnight Fed funds rate to a range of around 3.5%.
Yeah.
So
I think low threes is more realistic by the end of 2026,
yeah,
but I cannot predict the future. And that I don't think Jerome Powell is a major loser like Trump called him the other day, but that's okay.
they're at the Fed's at a disadvantage because they're always dealing with data that's in arrears or in the past.
Yeah.
And the past, we all hear that past performance is not indicative of future results. Well, it's kind of the same with the economy. You can kind of see things slow down a little bit, and we'll talk about that in a moment.
hmm
But there's no way to predict the future, and a lot of times, they want to be overly cautious versus trying to, just stimulate the economy for the sake of stimulating the economy.
Right. Here's a look back of the kind of the current rate cycle, if you will. Starting in 2022, we can see the historic rise all the way up to mid fives for the Fed funds rate. And yes, they did cut slightly at the end of 2024, but you can see in perspective how much they cut versus how much they raised. And we have a long ways to go. And I don't think we'll see for decades the Fed funds rate being below 1 and approaching 0, but it might,
The era of cheap money is over
it's
with.
over.
Yes.
Yes. And we all got used to that. We got used to 2 and 3% mortgages. We got used to 0% car loans and things like that. And I think it's going to be a while.
So let's look at the yield curve in terms of the spectrum here, from looking at this from short-term rates all the way to long-term 30-year rates.
hmm
And the big change that we've seen in the last few months, Jesse, is that the yield curve is uninverting. You're starting to see the short end of
Yes.
the bond market curve begin to fall, and the longer term rising above the short term.
Yes.
We want to see this inverted, and it usually means that there will be start market volatility during that time once it happens. Now, what's interesting here and what concerns me, and Jesse may have comments on this, is the U shape of the curve. Those 2-year, 3-year, and even shorter term treasuries like that are still really low rates.
Yeah, you can get, at least at this exact moment in time, you could get a 4-month T-bill at the same rate as the 10-year treasury.
Yeah, and that's unusual. So that will have to write itself out. It look more of like a hockey stick is the way it should look.
Mhm.
But that will have to change gradually over time.
I did see yesterday that the 10-year was fluctuating around 4.2.
So that's even up in the last few weeks.
Yeah, it's been volatile. That might continue, but we'll see. Let's talk for a second about inflation. This is our data going back to 2014, and you can see the historically massive high inflation in 2022, getting above 7%. The dark line is the PCE, which is the Fed's preferred indicator. And then the yellow line is the core, which excludes some volatile food and energy, things like that.
Right.
But inflation really, it took a dip in the beginning or the end of 2024, went up just slightly in 2025. We don't know how tariffs are going to change this chart, but they probably will.
Yes, we do think that it'll cause inflation to go up just a little bit, although they just reported the PCE for April, or excuse me, March, and that was basically flat in the month of March.
Right. So here's 5 key areas to focus on, and we did borrow this from our peer and our friends over at the Dividend Cafe. Check them out sometime if you want more market commentary. But first, stock prices. At the beginning of the year, companies' earnings were expected to grow fast. Whoa, I'm sorry. Were expected to grow fast, and now there's some concern that they might not be growing as fast, and expectations might have been too high, which could put pressure on stock prices. And of course, the valuations for a lot of these massive mega cap companies have been high for the last 3 years.
But they pulled back in the month of March, and certainly since December a little bit to be more in line with things.
Yeah.
And we have to remember earnings season started this week.
Yes.
So there'll be lots of news about earnings and things. There are a few companies that beat estimates. There'll be a few companies that didn't make estimates. That's going to have an impact on the market as well.
What about artificial intelligence and specifically the CapEx, like the expenditures that companies are having towards AI?
Well, there's huge investments in AI in the last 2 years.
That's what the markets responded to that last year.
Yes, and investors are seeing that this is the way of the future, and yes, I think it will be. I was giving a talk last week to a group of advisors and kind of compared to where we are with AI now to back when I was a teenager and I had an Apple IIe and started learning to program things and stuff and write code. And I was so proud of myself because I made a picture of a football with 5 or 6 lines of code. And look at today. And that's kind of where we are in the infancy of artificial intelligence. In 20, 30 years, we're not going to recognize what's going on and how easy it is, how much things will change in the span of a generation.
And now you can send me fake generated videos of a baby and a dog talking about the flavor profile of dog food.
Yes, I think the Talking Baby podcast is a really funny podcast.
Number 3 here, obviously tariffs. These trade policies could shift quickly and greatly impacting these companies, big and small, and the broader economy. We've been talking about this for a while now. We are currently in this 90-day pause where we hope to see some resolution and negotiation from these countries, but we will see what happens. We are still very much in the unclear phase.
Taxes. Trump keeps promising a big, beautiful bill that will come in. There's still negotiating going on in Congress. There have been some hurdles that were passed in the House for locking in either the Trump tax cuts from his first term and making them a little bit more permanent or at least extending them. And then there's also a lot of other amendments to that people are trying to get things like doing away with the state and local tax cap of $10,000. That would be beneficial to people that have larger homes. A lot of different things like that are going to be negotiated and debated.
No tax on tips, he keeps talking
No
about.
tax on tips. That's another big one for that.
But I mean, what do you think? November at the very earliest that we'll see this?
I know. I think we'll have a resolution before the end of September,
Okay.
which is simply because you're going into the new federal budget year,
Yeah.
fiscal year,
Yeah.
and on October 1. And then, of course, interest rates, Jesse, monetary policy.
Yeah, that's our fifth point here. If the Federal Reserve is expected to lower rates this year, the markets are pricing that in. So if that doesn't happen, that's going to be a negative side effect. If the economy stays steady, this would likely be good for investments. We got economic data yesterday, which we'll cover in just a second. But if the economy weakens, it could really be a challenge. But let's talk about the data we got yesterday.
Yeah, no, let's talk about gross domestic product that came in the first quarter. It actually, real GDP declined minus 0.3% annualized. Now that just, you basically take that 0.3 and divide it by 12, and that's how much it contracted.
Yeah,
And
very small, but still negative.
Very small, still negative. Now, in order to be technically in a recession, the economic definition is 2 quarters of negative GDP growth.
So next quarter's data provides the opportunity to be in a
Right,
recession.
but if you remember during the Biden administration, we had that happen to us,
And they changed the rules.
they changed the rules. It's not, no, that's not a recession. There's nothing to see here. Pay no attention to the man behind the green curtain. So yes, but the real drag here on GDP, real GDP growth came from net exports. Okay, so companies were rushing to import goods before the new tariffs hit, or the fear of those new tariffs hit, right?
We saw the same behavior in people spending money. They were going crazy buying cars and things that they import.
Oh yeah. Now the core GDP was really focused around personal consumption, Jesse, and business fixed investments, home building, etc. It rose in the first quarter at an annualized rate of 3%, not 0.3%, but 3%.
Right.
So that's a very healthy. Consumers in the US are still spending, and that's important.
So essentially, the American consumer is not feeling like it's in a recession right now.
We may be starting to act like it is,
Uh-huh.
but we're not really feeling the effects of that.
Yeah.
Okay, let's go on to the producer price index. You'll have to explain this, Jesse.
The producer price index is just another one of our economic indicators. I think it's a leading indicator. Correct me if I'm wrong,
Yes.
Mark, but yeah, it just helps us get another view of the economy. These companies producing things, what are the costs to them, and how does that trickle out
And it's
to
a
the consumer?
measure of inflation.
Yes, very much.
So that producer price index actually dropped 0.5%. And there was an expectation for no change, but it's actually the biggest monthly fall since early 2020 during the pandemic.
Yeah, we had a steep decline in energy prices. You might notice at the pump that gas is cheap right now.
Yeah.
Which is great for our monthly budgets and our wallets. But what does that mean for economic data?
Well, when you take out food and energy, because those two things can bounce around quite a bit, the prices still tick down slightly. And this is important because it shows that inflation pressures are easing behind the scenes, especially for goods and services.
Supportive of the Fed making a cut soon, potentially.
Potentially, but I think what's interesting here is a lot of people are stuck on the tariffs and so forth. And the reality is those tariffs don't affect our trade of services, which the United States is a huge exporter of services.
They're only looking at goods.
Yeah, all these other tariffs really are applying to goods.
Real quick, we'll look at existing home sales and the health of the housing market. The number of existing homes sold in March fell by 5.9%. Fewer homes sold than expected, and sales are down 2.4 compared to this time last year. That's kind of expected given the situation going on right now. People are not extremely confident in their financial future.
And there's higher interest rates.
Yeah.
So I'm less likely to sell my home that I've got a 2.5% interest rate on so I can go buy a new home and pay 6%.
Yeah.
That doesn't make a lot of sense. And for me, that means I do not have an itch of any kind to move.
Yeah, I'm studying for my CFP right now, and I was
Yes,
doing amortization schedules with my calculator, and I realized that when interest rates get above 7% over the length of a 30-year term mortgage, you're actually paying more in interest than the value of the home.
that's right. My first home loan was 9%. Yes, and I paid it off quickly.
Good. Housing starts, this is new homes. We'll just shift for a second to talk about the construction side of things. This dropped 0.8%, but it was mainly due to fewer apartment and condo buildings starting. So the big corporate style projects are declining. It doesn't seem like single family homes are declining nearly as much. It makes sense. The big companies are actually balancing the tension going on right now because they are tied to things like the 10-year and the market performance, and they're looking at all those things versus the average consumer is really just, for the most part, buying and selling when they need to, less affected by those things.
Right. So how does this all impact you, folks?
Well, we have a lot going on right now, and I hope in this presentation we're able to calm your nerves and assure you that you're going to be okay. And headlines will continue to try to draw viewers, and they do that by being dramatic and extreme.
It's interesting to watch the reaction to the GDP announcement. Was that yesterday or that happened or day before yesterday? I can't remember exactly what day this week was. But it was interesting because economists, you'll talk to, if you talk to four economists, you'll get four different opinions. And people are going to err on the side of caution, but also to, you have to know, this is one of the things that when I was working on my doctorate degree in economics and public policy, that you quickly learn which economists had a political bias.
Mm-hmm.
And so depending on which television show you watch, you will see that bias come out, both good and bad. And so just be wary of that. Know that no one has a crystal ball, although I've been getting lots of requests for my use of my crystal ball. It doesn't work. No one has a crystal ball to be able to predict the future. Is the likelihood of a recession stronger, greater than it was 3 or 4 months ago? Yes, slightly it is.
Mm-hmm.
But we're seeing that tempered by continued consumer demand and spending. And if there is one, it will hopefully be very mild.
Yeah, that I did not realize that the core numbers were so much stronger than the negative real GDP
But that's the
decline.
only thing you hear about is the real GDP,
Right, that's
which
all
is
they want to talk about.
dramatically impacted by a net increase in imports.
But a 3% gain in the core over year would be spectacular growth for the country.
From what we've been used to in the last 2 decades. But normally that's still kind of okay
Yeah,
growth in a normal economy. 4% is even better, but we'll take the 3%.
right. But yeah, here's four quick points. The tension here in the politics of everything is going to fuel emotional responses. So please avoid those. Market breadth, we've been talking about this for over 2 years. It's not where we want it to see. We want various asset classes and company sizes to be moving in tandem, and they're still not. The large companies are still running the whole world and running the market. We'll expect that to change at some point, but it hasn't happened yet. The higher interest rates are affecting borrowers, and I think our overall point here, Mark, is that your long-term plans need to account for volatility and policy uncertainty.
Yeah, and then I'm hearing questions like what we heard in 2008.
Yeah.
And for folks that are approaching retirement, you're nervous, I understand. But the point we have to remember, especially, is you have to have a long-term view of your investments, because you're not going to withdraw all your retirement money and stuff it in your mattress when the day you retire. No, you will
Yeah.
continue to have it invested over hopefully a very long time,
Sure.
and you will experience potential growth, ups and downs, and that's part of the changes that we have to deal with since the ERISA laws back in the 1970s, when it became our responsibility, in other words, the investor's responsibility to prepare for retirement.
Yeah. And when we get those client phone calls, the emotional response phone calls, and we ask, well, are you going to spend your entire net worth tomorrow? Well, no. Just keep that in mind. And I know that's not easy to swallow when you're hyped up emotionally.
Well, from a psychology standpoint, the fear of loss is 5 times stronger than the pleasure of gain.
Right.
And so I understand. We understand. I don't like it either. But I think things are beginning to calm down a little bit.
One quick little aside here. We did see our 401k tool react to the conditions happening in April, and that can apply to every 401k in the country. So if you are feeling lost with your 401k at work and you don't know what to do with it, please sign up for our tool. We can provide that to you, and you can feel like you're at least having eyes on your program and the investments within it. But overall here, Mark, what does this mean for your financial plan? I want to leave the listeners today with a positive tone. Is that okay?
Yeah.
We
need to, because that's what I'm feeling.
We are optimistic about the future, right? The markets will continue to be volatile until the tariff situation is clear, and that's for the U.S. and its trading partners. What did you tell me the other day? Bad news, but certain is better than uncertain news.
That's right.
So we just want to know what's going to happen. We can react once we know what's going to happen. The stock market is not broken or a lost cause because of the actions of administration, which you could easily find in the news right now. And we do remain positive for the future. Like Mark said, was April the market bottom? I don't know. We don't know for sure. The crystal ball didn't tell us today. But what I do know for sure is that your financial plan was built to withstand situations exactly like this. This is a unique situation that has never happened before in all of its specific ways. But what I can tell you is your financial plan is built to weather this storm. Do you agree, Mark?
Yeah. And if you're working with us, if you have another financial advisor, you may want to talk to them, see what their perspective is. But you should be reviewing your financial plan every year. And that's something that we do with our clients. If you are not a client and like to get some more information, we'll be happy to talk to you. Jesse, I don't see any questions on the board. We'll go ahead and put up the links there.
I'll turn the camera back on so you can bid them farewell.
Yep. And you can still text us. That number's not up there right now, but 254-282-0495, or send us a message at info@ClearVista Financial. And of course, give us a call sometime. Happy to visit with you about anything.
Yeah, that number there on the screen is actually our office line that's available from 8:30 to 5 business days.
Yep.
But the text line is 24/7.
And we have a special announcement today. Jesse, this is Jesse's last market update with ClearVista. We are so excited for him. He is moving to back home to Nashville to work with a firm that we are very happy for him to go to, and we wish him the best on that. And you'll be seeing some new faces along the way in the coming months. But we want to thank Jesse for his service to our clients and things, and look forward to see where God might take you.
Yeah, well, thanks,
in these
Mark.
coming years and stuff. So
Lots
thank
of
you.
exciting things happening in the future, and I would love to stay connected if you're curious about what that journey looks like. But yeah, it's been a pleasure presenting this information to you all for a while. So thank you, Mark.
All right. So folks, you've been listening to the monthly market update, ClearVista Financial Perspectives. Thanks so much for joining us. If you have questions, please reach out. Thanks.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and ClearVista Financial are not affiliated. Discussions in the show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.